Good morning and welcome to Cafe Mutual YouTube channel. We all heard about benefits of asset allocation, but it is easier said than done. Also, many MFDs are skewed towards equity funds and debt funds to some extent. They have minimum to very little exposure to commodities like gold and silver. To understand why MFD should look at commodities like gold and silver, today we have with us Vikram Dhawan, Fund Manager Commodities Nippon India Mutual Fund. Vikram has over 28 years of experience in commodities market and fund management. So let's hear directly from Vikram. Welcome, Vikram, to the show.
Yeah. Thank you very much, Nishan, for inviting me on your show.
Vikram, what is your near-term outlook on commodity market, especially gold and silver?
So, when commodities post the Russian-Ukrainian war, but it's still going on. The war is still going on, so we can't call it post. But um, they have become more strategic in nature, um, and as we saw that how the energy and the agri commodities were weaponized during this war. And this has led to a lot of insecurity across the world because Europe, as we saw, clearly was caught between the crossfire, and they had a very tough time as far as securing the supplies of gas and oil is concerned. So I think and now we are also living in an era of de-dollarization in from a unipolar world which was America dominated. We are now going to at least a bipolar world where you have China and US on the other side, and China is not only the largest consumer of commodities, it is also one of the largest producers of many critical commodities which are used in the new so-called the new tech and defense, etc. So I think there are a lot of undercurrents
Hmm.
which have made commodities very strategic in nature. So today, it's not just about the price; it's about obtaining long-term sustainable supplies of critical commodities at a reasonable level. So I think it has got two takeaways. First of all, you have to take a very long-term view on such commodities, and secondly, obviously, these trends takes years and decades to manifest. So you should have the patience to ride out the cycles as far as the investment and investment returns are concerned. Similarly, for gold,
Hmm.
gold has been beneficiary of the de-dollarization because last year the gold buying by the central banks was at all-time high. Just to give you an idea, out of the 4,000 tons, 4,000 odd tons, which is consumed every year for gold, almost 1,300 was bought by, or rather consumed by the central banks, which is almost a third of the total demand, which is at all-time high. This is like a 50 or a 55-year high as far as the central bank demands are concerned. Why they are buying it, and this trend is not something which started recently. If you see the central bank buying post 2016-17, it had both China and Russia have been leading the central banks in terms of buying gold. And, so this is part strategic, and this is also part because of the geopolitical, change that we are seeing in the world. So, all these things are coming into play as far as commodities are concerned. Yes, demand supplies will make difference as far as the price trajectories are concerned. But I think you will also have to treat commodities as a strategic asset now.
Okay. So, Vikram, I'm curious to understand that while silver has some industrial use, as you mentioned, gold does not hold any utility. So, what determines the value of gold?
So gold, I think, first of all, is one of the, in my opinion, one of the best safe havens. Now, the by definition, safe havens should perform well in times of economic distress,
Hmm.
which it has. There's a study done by World Gold Council, which has, it's available on their website if you want to see it,
Hmm.
where they have, analyzed historic data, and they have stated that whenever the correction in the global markets risk assets is one or two or three standard deviation,
Mm,
during that time gold is the one of the best performing commodities or asset classes.
mm,
Secondly, there was also study done in the US where it was revealed that at times of recession, and they took past 50, 60-year data, at times of recession, gold is the best performing commodities as far as the historic data is concerned. So add to that the liquidity which gold has. Now, many investors may not be aware, but if you talk about liquidity of top 10 securities or indices in the world, the most we're starting with S&P 500 of US, which is most liquid,
mm,
followed by US Treasuries, and gold would be in the top five. So so you can imagine that gold is one of the most liquid assets. It's certainly between in top 10, if not top five, of the global assets, which is so liquid. Which means that you'll be able to convert it into cash or whatever, use it as a collateral in time of distress. And that is what we saw during COVID also in India, that households which had significant holding of gold and the unfortunate circumstances befell them, then they were able to use gold to sort of maneuver out of that crisis. So all these things make gold a very invaluable asset in your portfolio, and also and I would like to say one of the best safe havens. One thing I would like to add is that you know uh, gold doesn't carry any credit risk, and it is not hostage to any country's monetary policy. So that is also another thing which goes in its favor. Sorry.
So, Vikram, my next question is largely related to sales. So, in a way, the biggest competitor of gold ETFs and gold FOF is physical gold. So, how can distributors make paper gold more attractive for their clients?
So, in my personal opinion, gold and silver ETFs have been one of the best, invention of the financial sector. And why I say it is because, the liquidity of, and across the world, it is not just in India. If you take any ETF across the world, the liquidity in the ETF units traded is significantly better than the liquidity of the underlying physical market, which means that more often than not, the impact cost while buying or selling or investing in paper gold, especially in gold ETFs, is maybe lot lower than in the physical market. So that is one thing which is a big boon for the retail investors, because unless you are trading very large quantities of gold in tons, you will not be able to get fine rates in the physical market. Whereas in case of ETF, you can trade a single unit, and the impact cost, as I mentioned, may be significantly lower than the physical market. That is one thing. Secondly, if you talk specifically about India, the regulations of both gold and silver ETFs, and by the chief regulator of the securities market, which is SEBI, are very cut and dry, very clear. The mandate is very clear for the fund houses that they have to buy or back the gold ETFs by gold and silver bars of the highest quality in the world, which is the LBMA or London Bullion Market Association standard. With this standard is followed by almost 80 to 90% of the world. And secondly, in the Indian context, whereas more often than not, if you talk about gold or silver ETF in the overseas market, in the other markets, typically, the AMC will be under direct regulation of the chief regulator. Custodians may or may not be under the direct regulations of the chief regulator. Whereas in the case of India, both the AMC and the custodians are into direct, regulations of the chief regulator.
So, Vishal, how can MFDs integrate gold with their existing offerings?
So gold is one of the very effective portfolio diversifiers.
Hmm,
Again, there is no one size fits all rule. Just to give you an example, if your portfolio is skewed heavily towards risk assets like equities or junk bonds or whatever, then I think you may need gold to hedge the risks.
Mm,
Because as I mentioned, that in times of economic distress and volatility, high volatility, gold tends to
mm,
do better than most assets.
mm,
If your portfolio is very conservative, it is skewed towards fixed income or fixed deposits, then I think gold can be one of the addition to it
mm,
to attempt to increase the overall returns.
mm,
And if you have a balanced portfolio, then I think the balance will only be completed if you have gold, if you have, at least three asset classes, if not four. If you, really are looking at long-term returns and continuous compounding, irrespective of, what's happening in the market, what we call as an all-weather portfolio.
And what should be the ideal allocation to gold?
So there has been a few studies done on it. The latest one was done by the World Gold Council, and what they mentioned, it was done 2 to 3 years back, and they analyzed a typical Indian pension portfolio. And again, the research is available on the World Gold Council website. I will urge investors to have a look at it. And they analyzed a typical Indian pension portfolio, and they came out with this analysis that anything below 5% or anything above 15% will be suboptimal for your portfolio as far as gold is concerned.
Vikram, one specific analogy that I would like to point out here. Equity and fixed income were negatively correlated in the past. However, of late, as the market is maturing, the correlation between equity and fixed income became positive. This can happen with other asset classes like gold as well. And people buy gold for hedging, as you have mentioned. So, what is your comment on this?
So I think in the medium to short term, the markets can move in any directions. You may have a situation where gold is positively correlated to equities or bonds, or equities with bonds, or as the case may be.
Hmm,
Why this happens? It happens for two, three reasons.
hmm,
First, if there is a deliberate intervention by a large global central bank,
hmm,
as we have seen that today interest rates are not being discovered; they are being, directed by the U.S. Federal Reserve as far as dollar is concerned. And same in India also. I mean, we have a central bank which is sort of leading the way as far as what interest rates are best suited for the country. So again, in this environment, the correlation tends to go haywire, because again, this is not a natural situation of a market, but it is something where some macro, whether it is economic growth or inflation or a recession, something extreme has happened, and this is nothing but the side effect of COVID and post-COVID environment. So I think in these kind of situations, you will have the correlation going haywire. Nothing much should be read in that, because once the market go back to autopilot, then the correlation, as we have seen historical, then tend to positive or negative correlation tend to sort of are reinstated. So yes, it may happen in the near term, but I think if you are an investor who is looking beyond 2 to 4 years, as I mentioned, then I think you will actually, if you've got the fundamental rights, right, as far as your portfolio or asset allocation is concerned, you will do well.
okay. So, one last question, Vikram. There are instruments like SGBS which offer 2% over and above the gold price. Why do you think that gold ETFs and gold FF still make sense for investors?
So I think first of all, there is, as I mentioned, gold ETFs um, with all form of gold, investment gold, not trading gold. All form of investment gold are most liquid, and as I mentioned, they are all backed by physical gold. So you may want to buy gold to hedge against credit risk. So which physical gold has got no credit risk, as I mentioned. So these kind of things will obviously be only available in gold ETF. Secondly, if you are an investor which believes in capital markets, for wealth creation, then I think you may want to have, as they say, the fruits from the same market and not just pluck fruits from different ecosystems. So
Mhm.
there it becomes very convenient for you because, as I mentioned, at the end of the day, what you would want to achieve is long-term compounding and a portfolio which is liquid, which is well managed, diversified, convenient, not something where you may want to squeeze out an extra return from something which may or may not be as good a diversifier as maybe something which is more liquid like a gold ETF. So yes, we are not denying that there is an angle for investing into other products of gold like SGB or digital gold or physical gold, but I think purely from asset allocation point of view, I think gold, you would rather prefer a gold mutual fund because it is part of the same ecosystem. And also, I think this is something which, so we have physical gold, we have other products, but again, what we have to also appreciate is that asset allocation story in India is very, very nascent.
Mhm.
The total AUM of multi-asset funds is just 1%, whereas if you compare it to the peers in the overseas market, it can be anywhere between 10 to 30%. So I think there is growth options available for all types of gold, whether it is physical gold or digital or SGB or ETF. So all can grow. There's enough, headroom for all these products to grow.
So, all right, we have come to an end to this interesting session. Thank you so much, Vikram, for your time.
Thank you very much for inviting me.
And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys. Bye.